Hey guys, welcome back everyone. In this video we are talking about the continuation of the foundations of risk management revision, and today we are focusing on chapter number 4, chapter number 10, then chapter number 9, then 5, 6, 7 and 8. Okay, so these are the readings that we are going to do today, and this is going to be the order that we're going to follow. There's a connection among these 3 chapters, so that's what we are going to take first, and then we are moving on to the rest of the chapters. And just to let you know, I have already uploaded this e-revision book on my Telegram channel. If you're not part of it, I'll put a link in the comments or in the description box below. You can check it out, you can join it, and you can download it. And also I am sharing this ebook here in the description box below on YouTube as well, so that you can download it if you want from here as well. And if you're new to our channel, consider subscribing the channel. This is our email ID, queries@vardies.com. Get in touch via email if you want. Feel free to contact us on WhatsApp for any guidance on the FRM exam. Alright, so there we go to the 4th reading. Okay, so the reading number 4 is the credit risk transfer mechanisms. Now, before we understand how do we do the transfer of the credit risk, let's just go ahead and let's just spend some time here on understanding the securitization. Okay, this is very important for us when we are doing reading number 4, 10 and 9. It's important that we understand the background of securitization. Okay, so this diagram that I have created will help you all to see how visually as to what securitization is and how it works in a much better way. Okay, I always use diagrams so that you understand in a simple way. So first we have a bank here, and they will give out mortgage loan to all these different borrowers. Okay, now usually what used to happen was that banks, they used to keep these loans in their own balance sheet as an asset, and they used to enjoy all the periodic payment of interest and principal. Okay, so that's how usually that used to work. And this type of a business model wherein bank will give out these loans to the borrowers and they'll keep them in their own balance sheet is known as buy and hold. So this thing that you see, buy and hold, so this is a model wherein banks traditionally they used to keep the loans on the balance sheet after sourcing the loan. Okay, so they enjoy the periodic interest and principal payment, but the only problem was that the credit risk used to be there in the bank's balance sheet. I mean, any borrower or any customer, if they default, then the bank used to suffer that losses. Okay, so that's the traditional way, but let's now have a look at how securitization has helped the banks prior to the financial crisis. So first, bank will give these loans, and then all these loans then will be transferred to this SPV, okay, special purpose vehicle. It's a third party legal entity. Then out of these pool of loans which has been transferred here, the securities will be created, which we will call it as either bonds, either asset-backed commercial paper, either mortgage-backed securities, asset-backed securities. We're going to call these securities, and then these securities will be created into these different layers, or these categories are known as tranches. Okay, I want you to remember this terminology. Tranches, that is senior tranche, mezzanine tranche, equity tranche. Okay, so these are the layers of securities that has been created by the SPV with the help of all these pool of loans. Okay, and then these securities are sold to the investors. Okay, so investors will buy these securities created out of pool of loans. Now, I want you to pay attention here that the beautiful thing about this entire securitization process is that banks are getting their money back quickly. How? Let's say investors are buying these securities, so they are paying to the SPV. So SPV is getting the money from the investors, and then SPV will give the money to the bank for buying these pool of loans. So it is a great situation for bank. They really don't have to wait for like 20 years to get their money directly from the borrowers in terms of interest and principal payments. And just imagine, on top of that, there is no credit risk. All these pool of loans are transferred here. So credit risk is essentially borne by this SPV. the bank balance sheet, there is no credit risk at all. So clearly it's a win-win situation for bank, and this business model that the bank will operate will we call that as originate to distribute. Okay, in this, banks first originate the loan, just we have talked about. They pool the loan together, transfer to SPV, then SPV will issue securities with the different layers or tranches as we have talked about, and will sell to the investors. Okay, here the banks are basically transferring the credit risk to the SPV, which is a third party entity. Alright, okay, now few things to note here, and I would like to also give a brief idea about these different securities that the SPV will create. The very first is a bond. We are all about as bonds. The asset-backed commercial paper is a commercial paper which has been backed by the assets. Now over here there are mortgage loans, okay, these home loans. There could also be credit card receivables, right? That is also possible. That there could be auto loans as well. There also could be student loans. So all these different all these different assets that the bank has, they can transfer that. Okay, so when we have a short term, like a commercial paper, short term security that will be issued by the SPV, that is referred to as asset backed commercial paper. MBS is when we have specially these mortgages. Okay, when a pool of mortgages, only the pool of mortgages is transferred to SPV and we create securities out of that, that is referred to as mortgage backed security. And asset backed security is when we have a combination of all the different assets, so that's we call it as asset backed security. Now asset backed commercial paper and asset backed securities, these are two different things. Its commercial paper is for a short term and this could be for a long term. Okay, so just to remove the confusion, you shouldn't be confused now. Alright, and one important point to note is that you will often hear the term CDO, CMO, CDO squared. So what do we mean by that? Essentially, CDO is the entire essence of securitization is referred to as CDO, that is collateralized debt obligations, and out of these collateralized debt obligations we create a structured products, so that is referred to as CDO. Talking about CMO, when we just have mortgages, okay, and the mortgage are collateralized, they are transferred to this. So overall, when we have a process like this, with just mortgages involved in it, then we call it as CMO. Now to understand this CDO squared, let's first understand that these tranches, okay, I would also want to tell you one thing, that senior tranche is the tranche that will receive the first interest and principal payment from borrowers. Okay, then mezzanine will receive the interest and payments, and then after all the payment that are made to senior and mezzanine, if there are some payment left, then only equity tranche will receive the payment. So this is very risky in terms of receiving the payments. Okay, so if I buy this thing, I'm not sure if I will be able to receive the interest or principal, but this gives higher returns, and this one is less risky because you are kind of assured that you will get the first payment. But yes, this is the yield over here is very less. Okay, so we have talked about the tranches and their riskiness. Now let's just say that there's one equity tranche which is not getting sold to the investors. Okay, no one is buying this thing, it's very risky, no one is buying that. So what can be done is that I can take all these unsold equity tranche, and similarly I can go to another CDO and I would take out that unsold equity tranche from there, then another CDO, unsold equity tranche, and I can combine all these equity tranches of all these CDOs and I can make it as a one single new CDO with again these tranches as mezzanine, senior, and so on. Okay, so essentially it's going to look like this. This equity is broken down into again these three different layers. Okay, so that is referred to as CDO squared. We have combined all the equities that are not sold, not just from this particular CDO, but from another CDO, from another CDO, from another CDO. We club it and we create these three different tranches. Okay, and just to give you one more information, tranches, they were actually given out ratings as well. This will have the highest rating and the rating will flow down here, and then this may have comparatively low rating as compared to the senior, so on and so forth. The ratings were actually given to all these different tranches. So definitions, we have already talked about securitization, we have seen buy and hold. We have also seen the originate to distribute business model. Now let's talk about the features of the loan that was given out to the borrowers. Okay, we have something known as the subprime mortgage. So essentially, a prime customer is one who has perfect documents, he has a good credit score, so on and so forth. We call that as a prime customer. And subprime is someone who doesn't have a good income flow, who doesn't have a good credit score. Then these customers are referred to as subprime. Now mortgages that are considered to be higher risk than the traditional mortgages and are given to borrowers with weak credit history, we call that as subprime mortgages. Now essentially, understand this. See, what I want you to understand is that banks, they have a profit motive, right? They can give out more loans and they can sell it out to SPV and they can make money out of it. At the same time, if all the customers who are eligible initially, if they are all given out loans, okay, all the prime customers are exhausted, then the bank has an option to give out loans to subprime borrowers as well. Because just think about it, for a bank, they just have to give out loan, transfer it to SPV, get their money back, and all the people are buying homes. Of course, property prices are also going up. So bank is not worried about the lending standards. They know they have the property which their value is just going up, so they can recover their money as well. So that's again a win-win situation for a bank. So that is one of the reasons why bank moved on to the subprime borrowers as well. The next loan feature is the ARM, or adjustable rate mortgage. Let's say there is a 30-year loan period, okay, so 30 years, and then initially for the first 2 years the rate will be very low, okay, so that most of the people can go ahead and they can buy a loan and they can purchase the house. Okay, so initially the rates are low, and then for the rest 28 years the rate will come at par to the market. Okay, so that's what this adjustable rate mortgage means. Initial rates on loans are very low and then increases during the later years. Okay, what do we mean by liar loans? Even the applicants who whose information was inaccurate was given out loan just to make more profitability. So this is also was part of the loan features. 100% loan to value ratio. That means you do not have to give any down payment, zero down payment. Just go ahead, apply for the loan, get a house. That's it. These were something that happened prior to the financial crisis. Ninja loan, no income, no job, no asset, still you can qualify for a loan and you can purchase the house. That was also a part of the loan features. Alright, now let's talk about the learning objective for 8 different types of credit derivative instruments. So credit derivative, they are a derivative instruments that facilitate the transfer of the credit risk. So if you want to take the credit risk off your balance sheet and if you want to transfer it to some other counterparty, then you can use credit derivative. So let's look at the very first one, which is a credit default swap. So it is a type of credit derivative that will pay off when the reference entity or issuer default. Okay, I've got this diagram which will help you to remember this CDS, but understand CDS is just like an insurance. Okay, for example, I have this car with me and I go to the insurance company and I say to the insurance that okay, I'll pay you premium every year. Okay, and if anything happens to this car, if there is any damage, any kind of theft, then you pay me the value of that particular damage. All right, a very common insurance concept. And if nothing happens to the car, okay, for that 1 year period, if nothing happens, you keep this premium and that's it. I'll renew the insurance again for the next year. So on and so forth. I can go ahead and I can do that. Now coming back to this CDS, the person who is buying the credit risk protection is known as protection buyer, and the person who's selling, like the insurance company here, that is known as protection seller. And here I have this reference entity or a bond. So now consider this example that I have this particular corporate bond and I feel that within the next 6 months or 1 year down the line, this bond will default. So what I'll do is I'll go to this protection seller, I'll pay him the premium, and in case of a default, the protection seller will pay me back. Okay, if nothing happens, then the protection seller will keep this premium for assuming this risk on this particular bond or reference entity. Okay, so that's how the credit risk has been swapped to from the protection buyer to the protection seller, and that's why we call this as credit default swap. Simple. Okay, let's look at the advantages. Now, it's a great source of cash flows to the protection seller. Imagine if there are two bonds and okay, the protection seller knows that this bond will not default. You can collect money from the protection buyer and keep it, right? So that's a good source of cash flows. The second one is it enables risk pricing. Now, what do we mean by that? For example, I want to know the risk of this particular corporate bond. Now, with the help of this premium amount, I can go ahead and I can find that, okay, because if this is so risky, the premium will also be higher. Okay, so I can find or I can discover the risk involved in this particular bond. So that's one advantage as well. And talking about the drawbacks, the weak regulated product, the CDS was not highly regulated. This is something that we need to remember. And there's a false sense of security. The second credit derivative is the CDO. Now, we've already talked about it. It's a structured product that banks can use to remove the credit risk of their balance sheet. The essence of securitization is the heart of CDO. Now, talking about the advantages, yes, there are higher profits for banks, loan access to even subprime who were not even eligible earlier. Banks started to give out loans to them as well. So that this is actually a good opportunity for all the people who were in the subprime category. Easy way to transfer risk. Just form an SPV and you're good to go with the securitization. Drawbacks: it encourages risk taking. This is something that we saw, and it does encourages risk taking behavior. Risk concentration, as I said, subprime was the major factor. A lot of customers, they defaulted on their debt was the subprime borrowers. So a lot of risk was actually concentrated around that category. Alright, so moving on to collateralized loan obligation, CLO. Now, CLO is actually similar to CDO, but here the loans undergo rigorous underwriting. Now, this is important. In the CDO, the banks used to pool loans of prime customers, subprime customers, so on and so forth. But in this collateralized loan obligation, the loans that the bank will give out, they will have a rigorous underwriting standard. That means only people who are eligible to buy the home, only they will be given the loans, and only those loans will form the pool and sell it as a CLO. Okay, so that's the major difference. Now let's look at the traditional approaches or mechanism that firms could actually use to help mitigate the credit risk. The very first thing is purchase third-party insurance. I mean, it's simple, right? You purchase it third-party insurance. Now you don't have to worry about the credit risk. That's very simple. Netting of exposure for, let's say that this is a 1-year contract. There are two counterparties, A and B. Now A has to give to B maybe $5,000 and B has to give $2,000. Okay, so this is the situation at maybe let's say just day one. Okay, so they get into contract today and the next day this is the situation now. Okay, now with this particular diagram, let's understand few things here. The very first thing is that when you get entering into this contract at day 0, okay, ask for additional collateral. Okay, this is a perfect way to go ahead and to reduce the credit risk. Okay, so it's a great way to mitigate the credit risk. Ask for additional collateral. So that's what we mean by requiring collateral. The second thing is marking to market. Okay, the next day, that is in day 1, this is the situation. Okay, so for example, A has to give 5,000 and B has to give 2,000. So what we can do is we can settle. Rather than waiting to settle at the maturity here, we can settle the very next day. Okay, that is referred to as marking to market. Settlement of account the very next day, that is referred to as marking to market. Now, what do we mean by netting of exposures? Now, netting of exposure basically means if this has to give 5K, this has to give 2K. Okay, so it makes sense that A simply can transfer $3,000 to B. So this is referred to as netting of exposure. Rather than giving 5,000 and then receiving 2,000, it's better to give only 3,000. Now, termination clause would actually trigger when there is some sort of a default in a particular transaction. So bank has the option to go ahead and terminate the agreement before the maturity as well. Okay, so this is also one way. Now finally, reassignment is something that a bank could automatically transfer credit risk to a third party in case of an event. Okay, for example, if there is a downgrade of any issuer, then that particular credit risk will be transferred to third party. So it's reassigning it to someone else. That's what we mean by that. Okay, so these are the traditional approaches that can be used to mitigate the credit risk. Okay, let's evaluate the role of credit derivatives in the financial crisis. But before that, let's understand the credit crisis of 2007 and 2009 that I have summarized here. So prior to the financial crisis, interest rates was kept at a very low level. Now understand, when interest rates, if they are low, this means a great opportunity for all the borrowers to buy the house at a low cost. Okay, and people could simply borrow at low levels and they can acquire real estate property. So it's a good situation for the borrowers. Now the point to note is that all the qualified prime customers are exhausted. Banks needed more borrowers so that they can pass it on to the SPV and get their spread. Hence, the lenders, they started giving more subprime loans to borrowers who were earlier not eligible for home loans. Okay, so this was the second situation. Then we have to appreciate the fact that housing prices, they were actually increasing before the financial crisis, because see, understand, if the interest rate is going down, there is going to be a lot of demand for all the houses. Okay, so the housing prices, as we all know, the demand of any product that goes up, the prices will also go up. Okay, so the housing prices, they started to shoot up, and to attract more subprime customers, banks, they started giving out this ARM, the adjustable rate mortgage, wherein for the first 2 years the rate of interest is very low, and then after 2 years it's gonna come up to the market levels. This also fueled the housing prices. Okay, this also gave a boost to the housing price increase. And now let's talk about investors. See, the interest rate being very low is not a good opportunity for the investment, because you're getting low returns for your investment, right? So the entire securitization, that was actually a very great option for all the investors out there. Okay, and if this was not enough, even the securitized assets, they were re-securitized. There was also CDO squared was actually created, and just to let you know, very good ratings were actually assigned to all the tranches, so that more investors could be attracted towards securitization. Okay, so this is the point of the investors. But things started to change as the Federal Reserve, they began raising interest rates, and as the ARM rates got reset, borrowers, they started defaulting on their home loans, and this caused a large supply and low demand for houses, which in turn caused house prices to come down, or I would say crash. See, interest rate going down, people could borrow, they can buy house, the prices will go up. But on the flip side, the interest rate, if they go up, the interesting point is that this actually led to the house prices coming down. The reason for that is very simple, because majority of the people who bought these loans was subprime customers, and they could not afford the higher interest rate. Most of the borrowers, they started defaulting on their home loans, and when people are defaulting, that means there is a large supply of houses or any product, and when the supply is high, the demand will fall down. And just to let you know one important thing, the house prices, it crashed so much that loan was higher, but the price of the house was lower. So borrowers, what they found to be more prudent is that let the bank foreclose the loan itself, because the loan is of more value than the property itself. So if you read this, as the housing prices, they crashed, many borrowers, they found it to be prudent to let the banks foreclose the house in place of paying the full mortgage, which was actually of significantly higher value. The mortgage was higher value. This also reduced the housing prices even further. Okay, it had a negative impact on the housing prices. And finally, as the crisis, it started to unfold, the asset-backed securities, the CDO, they started defaulting, and this caused the credit spread to actually widen or increase, and this was followed by the eventual bankruptcy of many companies or banks, or probably bailouts. Okay, so this was a summarization of the credit crisis. Now we focus our attention to the role of credit derivatives. Okay, so understand, the crisis was more to do with the misuse of the pre-securitization process. We cannot blame the credit derivative products, we cannot blame CDS, CDO. The misuse of the securitization actually partially led to the financial crisis. And apart from this, there was a systemic concentration risk. That is, in the CDS, let's say the best example is AIG. AIG, they acted as the protection sellers, as an insurance company. So the entire risk was actually concentrated around these few providers in the CDS. And this is not just a bad situation for the protection sellers, this is also not a good situation for the counterparties. Imagine I'm paying to the insurance company for my car insurance, and the insurance company defaults. So that's bad for the counterparty as well. That's bad for me as well, right? So this also added fuel to the overall crisis. And on top of this, the CDOs and their overall complexity, that also added another layer of risk to the crisis. And finally, the outcome of the crisis was the Dodd-Frank Act. We've already spoken this in the last video in the corporate governance. This was actually created to protect the investors, and section 15G was also created to further protect the investors. Alright, so that was it. Now moving on to the next learning objective, the process of securitization. Explain that. We've already explained it. The business models that banks can use for securitized product. Now business models, as I told you, OTD and buy and hold. Okay, these are the two business models that we have already discussed, but let's discuss about the advantages of both these models and the drawbacks as well. The advantage of OTD is that there is a higher bank profitability. Of course, the bank was profitable in the entire securitization in this originate to distribute model. There was a loan access to almost all the borrowers. People who could not borrow earlier, they were eligible for that. So this increased the accessibility of the loans to them. Investor had different options. Understand, the interest rate was very low at that point in time, so investors getting good amount of money on their investment. So that's a very good option for the OTD model. And better risk management. The lenders, they could actually manage their risk in a much better way. They just transfer it to SPV, and their credit risk was actually transferred from their balance sheet. Okay, talking about drawbacks, it was a moral hazard. Since banks, they were just sourcing loan and selling it to the SPV, they did not have any incentive to make sure that the loans that they were underwriting, they should be of good quality. Okay, misaligned incentives. Absolutely, the OTD model, it actually encouraged the lenders to focus on short-term profitability instead of sustainability for a very long period of time. There was opaqueness. As I told you, the CDOs, the securitization, they're very complex. Okay, and there was also a lack of transparency in the process for investors also. So investors, they could not actually understand the risk that was involved in all those tranches or in the securitization overall. And talking about buy and hold model, well, this is a great option for banks because they enjoy periodic interest payment for a longer period of time, but the credit risk is actually retained in their books. So this is one of the drawback for buy and hold model. Alright, so with this, we are done with our fourth chapter. Now I'm not moving on to the fifth chapter, I'm actually moving on to 10th chapter because there is some connection between 4th, 10th and 9th chapter. So we have to follow a proper rhythm so that we understand the entire things in a much better way. Okay, so let's talk about the reading number 10, anatomy of the great financial crisis of 2007 and 2009. First learning objective, and second, describe the historical background and provide an overview of the financial crisis. Describe the build up to the financial crisis and factors that played an important role. Alright, let's just look at it. Prior to the financial crisis, interest rates were kept low, and this led to demand for house buying among the borrowers. We've already talked about this in the last slide. The move to the OTD model with the advent of securitization, banks, they started relaxing their lending standards, which also increased the real estate demand and the overall prices. See, as I told you, now everything that we will read, it will all make sense to us. It will follow from the previous chapter. Okay, securitization, it helped investors also because they were getting good returns as compared to low interest rates in the market. But when the interest rate were increased by the Federal Reserve, the ARMs were hit. Many people defaulted on their homes, and the housing prices, they fell simultaneously. And since many banks, they were funding was majorly short term in nature, okay, some institutions, they stopped lending to each other of fear of risking money. If I lend to a bank, and what if that particular bank default? So many institutions, they stopped lending to each other. Hence, these short term liabilities were actually not rolled over, and many faced huge losses. Now, this short term liability, the perfect example here is of Lehman Brothers, which we will talk about in the next chapter. Okay, the next learning objective, role of subprime mortgages. We have already talked about this. Compare the roles of different types of institutions. Yes, we need to talk about different types of institutions. Talking about rating agencies, they gave unrealistically high rating to the tranches. Okay, this was something that we have seen just to attract more investors. Ratings was given. And also talking about lenders and the mortgage brokers, they were incentivized by high commissions via the securitization process. So the lenders, there were some mortgage brokers who were actually giving out loans to the borrowers, so they used to get good commissions on the deal, so they were incentivized by that. Okay, now talking about the next learning objective, describe trends in the short-term wholesale funding market. Now here we are talking about two short-term funding sources. The very first one we have is the commercial paper, and the second one we have is the repurchase agreements, also known as repos. Consider this example to understand the commercial paper. Here we have one counterparty A. He goes to a bank and he purchases the commercial paper. Okay, so basically he's lending the money to the bank, and these commercial paper is for, in our example, let's say it's for a month. So after a month, this counterparty A will again go to the bank. He will hand over this commercial paper to the bank, and in return he will get the principal plus some interest component. Okay, alright, so that's how commercial paper work. They are short-term unsecured form of financing, and asset-backed commercial paper is a special case whereby the commercial paper is actually backed by some form of a collateral, okay, such as credit card loans. So now to understand repos, they are also a short-term instrument. So consider this example. Here we have two counterparties, A and B. A will lend the government security worth $1 million to this B, and in turn B will give out $1 million cash to A. So A has $1 million as funds, and B has the collateral worth which is government securities worth $1 million. And let's say this is also for a month. Now after a month, A will give out $1.1 million to B, and B will return this government security, okay, and this 100,000 extra is the interest cost to this counterparty A. Okay, so that's what we call repurchase, because A is repurchasing the security after a month, and that's why we call this as repurchase agreements. So here a bank will sell an asset but will also simultaneously agree to buy back the asset in the future at a slightly higher price. Okay, and also the thing to consider is that the SIVs, they were holding mortgages of these short-term instruments like the ABCP and the repos, so they relied on the ability to roll over these contracts at the maturity. That means buying one for a month and then closing that contract and roll it over or get into a new contract for another month. So they thought that they can continue this short-term funding sources for a long period of time. So there was a significant liquidity risk, funding liquidity risk in the event of a crisis situation, and this actually happened because as the housing prices declined, the lenders, they started questioning the quality of assets that these SIVs had in their balance sheet, and the lenders, they become reluctant to extend any further short-term loans to them, and that's how their funding was actually stopped and they could not manage to continue it further. So what was the response of the central bank? To prevent further systemic risk to have a domino effect on the overall financial system, central banks around the world intervened by lowering the interest rates and they provided liquidity support. Okay, so this was the response by the central banks. So with this, we are done with the 10th chapter. Now moving on to the 9th chapter. Okay, now let's move on to the one of the most important and I would say rather very interesting chapter in the entire Foundations of Risk Management, and that is reading number 9, Learning from Financial Disasters. In this particular chapter, we're going to be looking at various case studies that actually focuses on the various risk factors such as the interest rate risk. So there's going to be a case study for that. Then we're going to be talking about liquidity risk. There's going to be 3 case studies for that. Then we're going to be talking about model risk, hedging risk, so on and so forth, all the risk factors that we have learned. We're going to be talking about how these risk factors can turn the organization, a great organization, to go bankrupt or face major crisis. Okay. All right. So the very first case study is based on interest rate risk. Now, this risk actually comes from the changes in the interest rate fluctuation. So interest rate going up and down can have a major impact on firms or banks. So let's look at the very first case study on savings and loans, okay, to understand the damaging effect of interest rates. So the savings and loan, or SNLs, they used to function like a bank. Now, they were actually financial institutions, but they used to function like a bank. They used to have the same business model as bank, that is accepting deposit from the customers and giving out long-term loans. Okay, so they used to earn the spread between the short-term and long-term interest rate. So that was their business model. Now, earlier the interest rate was very low, which actually favored the SNL industry, and hence that was profitable for the SNLs. But in the late 1970s, due to rising inflation, the Federal Reserve, they raised the interest rates. Now, just by raising the interest rates, we're going to consider with these diagrams how the profit model was turned into losses. Okay, so we're going to go ahead and look into that right now. Okay, so that's the background, and now have a look at these simple diagram that I've just created. These are hypothetical, just to make you understand how probably that could have happened. Okay, so let's say that this is the time when the interest rate was low and it was profitable for the SNLs. How? Because if you look at it, this is time, and as you go through this time, okay, and these are the rates, the short-term rates, okay, that's what they used to give out to depositors, they were very low. Okay, and the long-term rates, the loan rates, which is a profit for the SNL, that was higher. Okay, so this low rate and this higher rate, the spread or the difference, that was basically a profit for the SNL. So this is a win-win situation for SNLs. But in 1970s, okay, due to rising inflation, the Federal Reserve, they had to raise the interest rate, and suddenly the profits, they started to convert into losses. Now look at this particular diagram right here. So after the rate has been raised, the short-term rates, as you can see, that has been raised by the Federal Reserve, and this shows basically the cost of the SNLs have gone up, and the profitability, they started to fell down because they were actually paying more to the depositors rather than owning from the loans. Okay, and this was the reason why the SNLs faced such a crisis. Now, this could actually sound very simple, right? I mean, interest rate going up probably could have a devastating effect on SNLs. Well, it actually did during the late 1970s. Okay, so there are few lessons that we could actually learn from this, and that is interest rate risk should be managed in order to avoid potential losses. I mean, we have seen that just interest rate going up, your business model is down. All right, so that is the reason why we work in the fixed income section. We work so much on duration, then we have convexity, we have effective duration, effective convexity. We have these concepts so that we can effectively manage the overall interest rate risk that a firm can face. Okay, few other suggestions. Duration matching strategy. Now, what is this? Basically, the deposits are for a shorter term. I mean, imagine anyone can withdraw the deposits, right? The loans, they are fixed and for a long period of time. So deposits, maybe having the same duration of deposits and loans, that was one suggestion that could be used for reducing this interest rate risk, as well as some derivative products like we can probably use swap to manage our interest rate risk as well. Okay, so that's it about the interest rate risk. Alright, talking about liquidity risk now. Essentially, liquidity risk is the risk of not having enough cash to meet the funding requirements. Okay, so there are two types here that we need to understand. The very first one is funding liquidity risk. So it's the risk that you're not able to meet the cash or the funding needs as and when required. This is a risk for that. And the second one here is the trading liquidity risk. Now this is the risk that you're not able to trade or sell your assets in the market for a good price. Basically, when you don't have cash in a firm and then you try to sell your assets or probably stocks, and then you have to sell at a cheap or a discounted price, that risk is referred to as trading liquidity risk. Okay, let's look at the case study. The very first case study is of Lehman Brothers. Now they were an investment bank. They invested very heavily in the US real estate market. Okay, so the major portfolio consisted of these real estate assets. They used to give loans and then convert these loans into securitized assets and sell it to investors. So basically they used securitization, and majorly the pool of loans were subprime borrowers. Okay, this is something that needs to be noted. And let's talk about their funding. So the funding for all these loans, it came majorly from the repo market. Now we've already talked about repo market in the last reading. It's a very short term funding sources. All right, now I've just drawn this simple balance sheet, a hypothetical balance sheet. Just understand this Lehman Brothers here. So let's say the assets majorly are loans and the liabilities are majorly repos. Okay, now look at this. During the 2007 housing crisis, securitized markets, they fell down and investors were unwilling to lend to Lehman Brothers in the short-term markets as well. So basically their loans, the assets that they had, they were falling down in value, and the repos, the money that used to come in for funding needs, that also stopped in the market, and at the same time their equity also started to fall off. Okay, now understand, where funding liquidity risk, they were not able to get the funds to meet their overall requirements. That was one risk that propped up in the Lehman Brothers case study. The second risk is the trading liquidity risk, that they were not able to sell their asset in times of crisis at a good price. I mean, just imagine $100 worth of something and suddenly the value falls down to $40. Okay, so that was the situation with the assets of Lehman Brothers. Okay, everything was going down, and this also hit the reputation of Lehman Brothers, and hence they filed for bankruptcy. I've made a full length video on Lehman Brothers on my YouTube channel as well. You can watch that in case you wish to. All right, but this is essentially the liquidity risk. It hit the Lehman Brothers and they were not able to survive. Okay, so that's what we have the case study for Lehman Brothers. Alright, now case study 2 for liquidity crisis, and the case study we have is Continental, Illinois. Now Continental, Illinois was once the largest bank in Chicago, and in the late 1970s they began issuing loans to commercial and industrial sector, and they started giving out these loans very aggressively, as well as taking large exposure in oil and gas market via this Penn Square Bank. Now this Penn Square Bank, they used to give loans to Continental, Illinois, because they were a very small bank, and all the large loans in this oil and gas market, they used to pass it on to this Continental, Illinois. But in 1981, Penn Square Bank became insolvent. How? Because the oil and the gas, the energy market basically fell down, and this is the reason why a small bank such as Penn Square Bank, they became insolvent, and Continental, Illinois held approximately $1 billion worth of loan in this oil and gas market. The market falling down here not only led to the insolvency of Penn Square Bank, but also led to large losses as defaults started to happen. Now talking about their funding, again it's a short term they were issuing certificates of deposits, and in such a crisis they were not able to get money from the US market because of the reputation. So what they did is they borrowed from the Japanese market at a very higher rate just to survive this particular crisis. But as rumors about their funding condition reached international markets, they were not able to borrow even at higher rates. There was a liquidity crisis in Continental Illinois, and just to let you know, depositors, they withdrew approximately $6 billion in only 10 days. You can imagine. Regulatory authorities eventually they stepped in to prevent a domino effect on other banks. Like one bank falling down, this can have an effect on the other one, and that can have an effect on the other one. So to prevent this domino effect of going one falling down all these banks, the regulatory authorities they had to step in. Okay, so this was the case study about Continental Illinois. All right, the third case study we have for liquidity is Northern Rock. Now, it was also a fast growing medium-sized mortgage bank based in the United Kingdom. They had a similar model, that is of OTD, okay, originate to distribute. We've already talked about this OTD business model. You go you follow the securitization process, you pool it and you distribute it to the SPV. That's what they had followed. Now let's talk about the funding of this Northern Rock. Their funding came from, again, short-term markets. Now you might have thought about it that majorly whatever case study you will see, you're borrowing it from the short-term markets and you're lending it out as a loan, which is a long-term product. Okay, somewhere or the other you might wonder that this is a mismatch. Okay, that's what we're going to be learning at lessons learned from liquidity. But for now, sticking to this Northern Rock, and they also accessed markets from Europe, Asia, and the US. Okay, so they did not rely on the retail deposits. I mean, for any bank, retail deposits matters a lot, right, for their funds, which was unusual among the UK bank peers. Now, this was something that was unusual among the UK banks. Now, but when trouble started to come in 2007 during the GFC, Great Financial Crisis, in 2007, many depositors they got worried and they started to withdraw money from the bank, fearing the bankruptcy of this Northern Rock. But the British regulators, they told the general public that they would guarantee 100% of all the deposits of Northern Rock, and this is how the run on the bank was actually subsided. Had not the regulators stepped in, they would have been bankrupt, right? So this is very important. Now let's talk about the lessons that we could learn from the liquidity linked crisis. So let's learn some of the lessons from the liquidity linked cases that we have seen. Now, as a result of the 2007-2009 crisis, the US Federal Reserve, they began to mandate liquidity stress testing programs. That means they asked the largest banks to focus on the stress testing, specifically keeping a focus on the liquidity programs, because we all know for a bank liquidity is so important. Okay, so this was emphasized. Also made them to consider about asset liability management. Now this asset liability management is important. I'm going to give you an example. Alright, to consider the asset liability management, understand that there is a simple balance sheet that I've drawn here, and the assets for a bank are loans. Okay, so the loans are the assets for a bank. The deposits that they get from the customers, they are liabilities because they have to pay it back, and any other funding sources that the bank may have. Okay, so this is a very simple balance sheet. So the lesson that we can learn is that when we are talking about deposits and loans, we have to appreciate the fact that these deposits, they could be for a very short period of time, but these loans, they are for a long period of time. So there is a mismatch. Okay, and that is why we need to manage this asset liability management. Okay, so that's what we mean by asset liability management, but it's not that easy. So there are two trade-offs that we need to consider. The very first one is the trade-off between the cost and risk mitigation. So when you try to reduce or mitigate the risk, the cost increases, and when you try to reduce the cost, the risk increases. Okay, how? Of let's say 5 years deposits and 5 years loans. Ideally, you'll not be able to make much money out of this, because the deposit for 5 years, that will also cost you more money because the duration is the same, and the loans, you will earn from the loans the same amount of money. So this way the risk is reduced, but the cost has increased. Okay, so that's why there is this particular trade-off. And talking about the second trade-off between the funding liquidity and interest rate risk. Now what this says is that if you manage your interest rate risk well, you will face funding liquidity risk, and if you're trying to focus more on this, the interest rate risk increases. Let me give you an example. So suppose the liabilities, they are of 3 months, okay, and the loans that you've given, they are for 5-year period. Now understand, you can manage interest rate risk well because interest rate fluctuations will not have much of the effects on the liabilities. Okay, that is one thing. On the other hand, the liquidity risk is significantly higher. These are short-term funding sources, and this can probably give rise to any liquidity risk. So there is a trade-off between this as well. Okay, so these are the lessons that we need to appreciate from the liquidity linked crisis. All right, talking about the hedging strategies now, let's see the case study on that. Before that, we need to talk about the static versus dynamic. Now in the last video, I've already explained about static hedging. In static, we just create one time hedge and that's it. It's kind of like we forget about it. We do not adjust our strategy. We just keep it and we focus on other tasks. But in dynamic, which is the opposite of the static hedging, it requires continuous adjustments to hedge the positions because the market variables, they change continuously. So when we are following this dynamic hedging, we need to make continuous adjustments. Now static is less expensive because it's just a one-time creation and also less time consuming as compared to dynamic. But something that needs to be noted is that static may not remain a perfect hedge. If we are looking out for a perfect hedge, then we should choose the dynamic rather than the static hedging. All right, moving on to rolling hedge. Now in this you buy 1 month contract and at the maturity you will close this contract and buy another contract to hedge your long-term exposure. Let me just give you one example. So let's say that we have this 5-year exposure to any commodity and we want to hedge this 5-year this long-term exposure. So effectively what can be done is, let's say if I have a 1 month contract, okay, and I will at day 0 I'll get into this 1 month contract, and when this contract ends here at the maturity, I will opt for another 1 month contract. Okay, so on and so forth. I will keep on closing my previous positions. I'll get into a new one, then again I will close out here, get into a new one for the period 3, then period 4, so on and so forth. I can hedge my long-term exposure. Okay, so this is the background for rolling hedge, and this is something that you would need in our case study, which is MGRM. Okay, so that's why I'm teaching you this thing right now. Okay, talking about backwardation and contango. Now backwardation is something like, for example, we have this, the time over here, and this is the price. Now as you can see, this is the futures price, okay, as we move through time, okay, as we go through time, and this is the price. The price are actually falling down in the future. So when we have a situation like this, wherein this spot price, okay, the near term or today's price, that's what we call as the spot price. So when the spot price, they are actually greater than the futures price, then we say that we have a situation known as backwardation. And the opposite of the backwardation is contango. If we have time over here and if we have price, then this is the futures price now, as you can see, and this is the spot price. So as you can see, spot price is lower than the futures price, or I can say that futures price, they are actually greater than the spot price. So if we have a situation like this, then we say that the market is in contango. Okay, so this is pretty much the background that you need to understand the case study for MGRM. Talking about MGRM, they was the US subsidiary of this firm, okay, and this firm was actually based out in Germany. MGRM was the US subsidiary of this German company. Okay, so basically what MGRM did is that, so they entered into a forward contract to sell, because they were short, to sell the heating oil and gas products. That was their deal. see, understand, if you're selling something, you have to buy, right? Now, what if the price of the oil and gasoline, if they go up? So that is a risk to MGRM. Now, to hedge this original short forward position, they entered into another contract. Okay, so to hedge the rising prices risk, they entered into a long futures contract. So they wanted to buy the oil and gas with a rolling hedge. Remember, I told you about rolling hedge. So this was their position. They will actually manage this 5 to 10 years of their exposure by getting into 1 month contract here, then second month, then third, and they will close on and they'll follow the rolling hedge. So that's what they thought. Now, when they entered the contract, the market was in backwardation. Remember, I told you this futures price and this is the spot price. Okay, so spot price are higher, futures price are lower, which was favorable for MGRM. Now, how it is a favorable? Because if you think about it, they are buying at the futures price, which is lower, and they will sell at the spot price, which is higher. So definitely it's a win-win situation for MGRM. But then the market actually changed to contango. Now, contango over here, if you look at it, this is the forward price. Now this is gone up, the buying cost has gone up, and on the other hand, the selling cost has come down. So due to the contango, this led to huge margin calls on their long futures position. See, understand, they got into this futures contract, and as we all know, the difference between the forward and futures is very simple. In a forward contract, anything will happen at the maturity over here, but in a future contract, you really have to settle profits and losses right the very next day. Okay, that is known as marking to market. So because they were long in this futures contract and they were facing this loss, they had margin calls and they could not actually meet this margin call, and that is the reason why their strategy of hedging this thing actually failed. Okay, so hope you get a background. So since the futures contract has daily settlement, meeting those margin calls actually led to funding liquidity risk. They couldn't find the funds to pay off this margin calls. Okay, while on the other hand, they made profit on their original forward contract, but unfortunately that contract will be settled only at the maturity. Forwards are settled only at maturity, not prior to the maturity. Hence, they suffered the losses on their futures positions, and even to unwind such a large futures positions, they had to take 10 days. So I mean, these margin calls were just piling up, and it took them almost 10 days to unwind that. So this also is referred to as trading liquidity risk. Okay, it takes very hard to sell your assets. And also the German accounting standards at that point in time also made the case worse for MGRM. How? Because they had to report the losses on their futures positions. Now this actually had a reputational damage for MGR, and on the other hand, they couldn't report profit on their forward position. So, and finally, these reported losses meant not getting debt from the market at a favorable rates. And I've also made a very detailed video on the MGRM on my YouTube channel. If you have time, I would rather say that watch that video as well to get. Okay, let's now talk about model risk. Now, model risk basically arises when either we are using an incorrect model, or probably we are having incorrect data in the model, or rather we are using some wrong assumptions in the model. Okay, so let's look at the case studies in the model risk. So the very first case study that we have is of Niederhofer case. Okay, so Victor Niederhofer, he was actually a very star performer, or rather I would say a star trader who ran a very successful and well-established hedge fund. So this was his background. His strategy involved writing large quantities of deep out of the money put options on the S&P 500 index. Now let me explain this. So let's say that there's this person A, and here we have Victor Niederhofer, or rather I would say that suppose this is myself, okay, and I will go ahead and I will buy the put options, and this Victor, he'll go ahead and he will sell the put options. Okay, now what would be the impact? If I'm buying the put options, I will only profit when something goes down in value. Okay, for example, we are trading on this S&P 500 index. If the index falls down, then I the buyer of the put option will profit, and on the other hand, the seller, which is the victor, he will profit if the S&P either goes up or remains stable. He will simply collect the premium from me. Okay, so this was the background. Now that's exactly how it works. So he used to collect the option premiums because what he assumed is that the S&P 500, they will not fall below 5%. That's what he thought. He thought that the market would not fall below 5%. That was his assumption, and he can simply collect premiums and make money. Now remember, he was selling deep out of the money put options, so that was his strategy. But in October 1997, when the market fell by almost 7%, margin call was actually initiated for about $50 million. Can you imagine? Such was the intensity which he actually could not meet, and finally his brokers liquidated his positions in discounted or cheap prices and wiped out the fund's equity. So that's how it went for this Victor Niederhofer. Hopefully you are able to understand that you cannot always win, or there's not going to be free lunch. Alright, the second case study, long-term capital management. Just to let you know, I've also put a case study on YouTube. Check it out if you have time to learn this in more detail. But just to give you a background of this case study, LTCM was founded in 1994 by this person, John Meriwether, and this LTCM was also backed by former Fed Vice Chairman David Mullins and Nobel Prize winners Robert Merton and Myron Scholes. Now you know the famous BSM models. They were the person behind this LTCM. Okay, so such a strong leadership LTCM had. Now talking about the leverage of the company, they had 26:1 leverage ratio. That means for every 1% of the returns the company will make, they can magnify it up to 26 times. So that was the leverage ratio. Okay, talking about the strategy, the trading strategy of the fund was to make arbitrage trades, also known as relative trades, so which basically involves taking advantage of arbitrage between the securities. Okay, basically buying one asset and selling another asset in an attempt to capture any mispricing. And the reason they had so much leverage was because these mispricing, they are very small. Okay, so to capture good amount of money out of this mispricing, they had to take on so much of leverage. Okay, now let's talk about the actual strategy of the LTCM. So the LTCM, they assumed that the spreads between the sovereign and corporate bonds in various countries were too wide, and they would eventually revert to normal levels. Now have a look at this particular diagram that I've just made. Now what they thought is that this is the normal level, okay, and they bought these corporate bonds thinking that it's gonna go down in value, and this government bonds, they actually sold these things and they thought that this is going to go up. Okay, so this was their initial thought process, and they would make huge amount of money if this thing happens. But this actually did not turn out to be true, and the LTCM downfall was actually triggered in 1998 when the government of Russia declared a moratorium on its debt and devalued its currency. So with this, their trading strategies positions was reversed. They faced huge amount of margin calls, and rather than this going down, it went up, and this also, the spread got widened, and they faced huge losses in with their positions. And with such a leveraged position, the losses were also magnified. Now let's look at the lessons that needs to be learned. Correlations need to be monitored. This is absolutely true, guys. They thought that their positions were correlated and they would win. In reality, their positions was reversed, and in a way that they did not anticipated. Okay, so the correlations between the trades, among the trades, that needs to be monitored. Always require margin money in trades. Now just to let you know, LTCM leadership was so strong that people, they did not ask for margin money while entering into a trade. That was a solid reputation. But it's always a great lesson that we need to learn, that whatever the background is, we should always have a caution while we're trading, and always ask for margin money in trades. Okay, so this is the second lesson, enhancing the disclosures. When it comes to disclosure, LTCM was actually a hedge fund. It was not required to disclose much of the details of its position. So basically, the real risk, or I would say that the true risk of their position was actually not visible with such a huge leverage. So disclosure is something that also needs to be taken into consideration, and also we should not have models that should underestimate the risk. So over here in the case of LTCM, VAR was understated. Okay, just to let you know, they had their VAR over here, but in reality it turned out to be 8 standard deviations away. Over here we have 3 standard deviations. So just imagine that this was such a huge error that actually led to the bankruptcy of LTCM. The VAR was very much understated. Okay, and finally, manage the liquidity well. So when the crisis hit, LTCM just couldn't manage to get out of that because they did not have much liquidity, and we know the importance of having liquidity, right? You have enough money, you can get out of the trouble that you are in. So this is very important for any firm. Okay, now moving on to the London whale. Now this case study happened in JP Morgan, and in the company, the division, its chief investment office, the CIO, they were tasked with managing $350 billion in excess demand deposits. Now there was this trader named Bruno Excel, and he was based out of London, and this trader in the SCP division, okay, this is another division in the CIO, they placed massive bet on the synthetic credit derivative. Okay, so this SCP, they placed massive huge amount of bets on this synthetic credit derivative. Now for the exam, just remember that synthetic credit derivative is a derivative product. Okay, and just to let you know the intensity, just in 3 years, the SCP's net notional size jumped from $4 billion to $51 billion. That is more than 10 times increase. Now moving on to 2011, the end of 2011, the management of JP Morgan, they wanted to reduce this risk weighted asset. Now for this case study, just remember that RWA, risk weighted asset, is just the assets that are weighted according to their risk. Okay, and this SCP, they had the most ROA, so it was necessary to reduce the exposure in this SCP. Now here the interesting thing starts. Rather than reducing their overall short positions, they bought more and more long options. Now just to give you an example, these are the original short positions of the of this SCP, but now to reverse their position, what they did is, rather than reducing this, okay, whenever you want to reduce a position, you would go ahead and you would try to wind up your contract, but rather than that, what they did is they opted for buying more long positions on the credit derivative. Okay, and on top of that, this portfolio was quite small. This was much larger and effectively increasing the overall risk of the portfolio. So that's one thing that led them to trouble. And apart from that, in 2012, okay, the CIO strategies were facing losses. To hide their losses, the leadership of the CIO, they decided to adjust the valuation methodology of their synthetic derivative. Now what do we mean by that? Now just imagine this is the starting price and this is the ending price, and somewhere in the middle will have the midpoint price. Now what they did is that they cherry picked the prices. For example, if this is the lower price, they will go ahead and they will report this. If for example this is the lower price, they will go ahead and they will select this. So they started to manipulate the overall valuation methodology of their synthetic derivative just to hide their losses. Okay, but this practice was eventually discovered in the March 2012. Okay, they could not survive this, and throughout this timeline, while they were doing all these things, the CIO, they were also breaching and disregarding internally established risk limits. For example, they used VAR. Okay, so their VAR limit was breached 330 times, and they disregarded this. Can you imagine that? 330 times. And not only this, they also changed the assumptions of the calculated VAR that decreased their value at risk by almost 50%. Okay, so they tried what the best that they could to prevent the losses or to hide the losses, but still they faced a loss of $6.2 billion. Okay, so this was the case study about the London whale. Alright, the next case study is Rogue Trader. Now this case is about Barings Bank, which was founded in London in 1762. The incident involved huge loss due to the unauthorized trading activities during this period by a trader named Nick Leeson. Okay, he was responsible for this rogue trading activity. Now Leeson was supposed to be running a low risk limited return arbitrage business for Barings in Singapore. So usually what happens is that in a traditional arbitrage trade, you buy underpriced security and you sell the overpriced security, but Leeson, he did other way around. For example, now one of his trade involved buying one security, okay, and there was no shorting or selling of another security when you're doing an arbitrage. So this was very unusual among his trades. Don't know why he did, but these trades, they generated a loss of 200 million pound. But let me tell you, the interesting thing happened here, that he managed to show profits worth 102 million pounds to the management. Now how could he do it? Because he controlled the back office operations, and he did some reconciliation, and he hit certain loss account that was actually never reported to the management. So by the time management got to know about this, bank was actually in deep trouble and it had to be liquidated. So few lessons to be learned from this particular case study is that scrutiny is needed to check the books properly. Okay, you cannot just depend on one person who's actually controlling the back office. Okay, so we need to check the books properly, and sometimes you have to question the so good to be true profits. I mean, you got this profit, how? You need to maybe question that sometimes just to get to the root of the issue. And most importantly, the supervision of the back office should be independent from the front desk. Now his authority to control the back office operations led to some hidden accounts that was making huge losses for the company. Okay, so these are the lessons that we learn from the rogue trader. All right, few cases on financial engineering. Okay, so forwards, swaps, options, the complex derivative products, these are the main building blocks of financial engineering. Okay, now let's look at these three case studies on the financial engineering. So very first case study is about Bankers Trust. In the early 1990s, Bankers Trust, they told clients, now the client was P&G, to buy complex leveraged swap to get lower funding costs. They wanted to reduce their funding costs, so they advised buy this complex leverage swap. But this strategy resulted in a huge loss for clients, and they actually sued Bankers Trust for misrepresenting the risk that embedded in these products. Okay, even the Bankers Trust, they could not understand properly these complex leveraged swap, so that's how that got them into trouble. So if you don't understand some complex product, it's better to stay away from it. Moving on to Orange County, they used repos to fund this complex inverse floating rate notes. Okay, and so initially what they did is they made profit out of this, but then interest rate increased, they faced huge losses, and finally they were forced for bankruptcy. So even they did not understand these complex products. Okay, so imagine Orange County, they had to go bankrupt by not understanding the complexity of inverse floating rate notes. The third case study is for this company. Now if you read this, you will realize that this German bank, they wanted to buy the subprime securities, but via this another unit that they had in Dublin to specifically buy these subprimes for them, for these Landers Bank. But as the crisis happened in 2007 and 2009, the unit in the Dublin, they suffered huge losses, and in turn this German bank, they had to be sold to another bank in Germany. Okay, so this was a very simple case study. All right, talking about reputation risk. A firm's reputation is based on the belief that it can and will fulfill its promises to counterparties and creditors, and that the enterprise is a fair dealer and follows the ethical practices. Okay, let's look at the case study for this Volkswagen. In September 2015, it was found that Volkswagen had been unethical in its environmental responsibilities. Basically, what Volkswagen did is that they programmed their software for their emission control to work only during this regulatory testing and not during everyday use. So this had a damaging effect on the reputation of VW on Volkswagen, and their share price fell by 1/3 as this happened. Okay, so this was the case study for reputation risk. Moving on to corporate governance, and the case study we have is Enron. Whenever you hear about Enron, the very first thing that should come to your mind is corporate governance. So yes, this case was about that. Enron is a perfect case of corporate governance failure. Basically, they painted a different story to the stakeholders regarding their performance. They actually managed to do some accounting fraud, and the auditors who were actually involved in this case, their license was also taken off. Below are the few pointers that we need to note to understand the Enron case. In the Enron case, there was clearly the agency risk. As I told you, agency risk is a very major risk that concerns the stakeholder, because the management, they put their interest ahead of stakeholders. They just thought of making more money for themselves. That's what they did, and that got them into trouble. Well, talking about the board, they did not oversee the operations of the management. And check this out, CEO and chairperson was one single person. As I told you, the best practice of any corporate governance is to have separation between the CEO and the chairperson. In the case of Enron, they were one person. The third thing we need to note is that they managed to hide their losses by using the accounting tricks, and they also changed the revenue recognition. How you recognize your revenue in your income statement, they changed that process as well. And also the auditor was implicitly part of the fraud. As I said, their license was taken away. So this was the case about Enron. And finally, to complete this chapter, we have the last case study, and that is for cyber risk. Okay, the case study is Swift. So basically over here, there were some hackers who accessed the Swift system. Now this is a system wherein we use for making international transfer of payments. Okay, so the hackers, they accessed the system of Swift, and they managed to stole $81 million from the Bangladesh bank, the Central Bank of Bangladesh. And after the 81 million was transferred to a bank in the Philippines, the hackers, what they did is they used some sort of a malware to delete the record of the transfer, and they also disabled the confirmation of the transaction. So any notification that we have transferred 81 million, so they disabled that notification feature as well. Okay, and when the Bangladesh bank, when they realized that they were not receiving any transfer notifications, and when they rebooted, when they restarted their system, they immediately received transfer notices, and this made them realize that cyber theft was the case behind this $81 million, which the hackers actually managed to stole. Okay, so this was the final case study, and we are done with this 9th chapter, learning from financial disasters. Alright, now moving on to reading number 5, that is modern portfolio theory and capital asset pricing model. So very first learning objective, explain the modern portfolio theory and interpret the Markowitz efficient frontier. Now let me tell you a background about the modern portfolio theory. Let's say that if I have a stock A, company A, and in my portfolio, and I'm thinking to add another asset like, let's say, company B. Now what I'll do is that if I like this company B, I'll simply buy this and include this in my portfolio. But what the modern portfolio theory says is that rather than just simply adding this stock into my portfolio because probably I like it, rather I should think about the overall portfolio and the effect of adding this individual asset into the overall portfolio. Okay, I should consider the expected return on this portfolio, the expected risk, as well as the correlation between these two assets. Okay, so the idea of MPT is that don't just think about individual assets, consider the whole portfolio and their expected returns, the risk and the correlations. Okay, so that's what the essence of modern portfolio theory is. Okay, talking about the assumptions, returns are normally distributed. This suggests that only mean and variance play a role in portfolio evaluation, nothing more than that. Okay, investors are rational, means that if given a choice, investor will pick the stock with the highest return, and risk averse, they do not like much risk. They will try to avoid as much as possible. That's what we mean by risk averse. Capital markets are perfect. Now what do we mean by this? Basically no taxes, no commissions. Of course, this is just an assumption of MPT. Alright, now consider these three diagrams that I've drawn, and these visual representation will actually communicate the idea of this modern portfolio theory in a much better way. So just I've drawn these things so that you understand it in a better way. Now this first diagram, it talks about diversification. Okay, here we have the number of assets, and this is the standard deviation in the y-axis, and as you can see, this blue line, okay, it comes down as we add more and more assets to the portfolio. As the number of assets increases, the overall standard deviation, it comes down. That's what we can see with this blue line. But even after adding all the assets that we could in our portfolio, only the company specific risk will come down. Okay, company specific risk is also known a non-systematic risk. Okay, this is something that you need to remember for the exam. So if you see non-systematic risk, it can be diversified away. Yes, company specific non-systematic, it can be diversified away. The risk will come down, but it will retain this much of risk. Okay, you cannot eliminate the total risk by increasing the number of assets into your portfolio. The risk that remains is what we call as the systematic risk, also referred to as beta. Okay, so if you see beta, systematic risk, they are one and the same. You cannot eliminate this market specific risk. This is something that you are assumed to take the risk when you're investing in the stock market. Okay, so that's what we have here. And also sometimes this company specific or non-systematic is also referred to as idiosyncratic risk. Okay, so if you see something like this, essentially they're talking about the company specific risk. Now have a look at the second diagram. This shows the effects of correlation, and as you can see, this is the risk here and this is the return on the y-axis, and a positive correlation of two assets. Let's say that we have asset A and B. If they are positively correlated, we can see that there is no diversification benefit. But as the correlation goes beyond this positive one, as it goes to 0, okay, we can see that yes, the risk over here has reduced, right, and as compared to this one, but the returns are the same. All right, so that's what we mean by the effect of correlation. If there are two assets, if the correlation is less than positive 1 or probably 0, or as you can see, even if it goes to negative, the risk is significantly reduced and the returns remain the same. So that's the entire point of correlation. Talking about the third diagram, we have here the efficient frontier. Now again, this is risk, this is a return, and these blue dots, they represent all the individual assets that we can have in our portfolio. Okay. So for example, if this asset and this asset, if I know the correlation is less than 0, so probably I can make up a portfolio over here. Then for this and this, if the correlation is 0 or it's less than positive 1, I can make up a portfolio here. So on and so forth, I can create these portfolios. Okay, I can create all these different portfolios by looking at the correlation, and this line that I can create, okay, this line that I will make, I will call this line as the efficient frontier. Now there's also something called as the global minimum variance. For example, understand this is offering the lowest risk possible. Okay, so that is why we call this as global minimum variance portfolio. And basically on this line, okay, this is something that you would always prefer as comparison to line that falls below this global minimum, because understand, if I have a portfolio here and if I have a portfolio here, obviously the risk is the same, right? The risk is the same, but this is offering me highest return, so I will go ahead and I'll pick this portfolio when compared in the efficient portfolio. All right, let's move on to the next learning objective. Now talking about this CML, see, understand that so far we just talked about including risky assets into our portfolio, and out of all these risky assets that was all available, we created this efficient frontier. All right, but now what would happen if I include the risk-free asset into our portfolio? Now our portfolio consists of both the risk-free asset as well as all the risky asset that is invested in the market. So once we create our portfolio with a combination of both the risky and the risk-free assets, our efficient portfolio, it turns into a straight line. Now this orange straight line that you see, and this is what we call as the CML or capital market line. Okay, so now rather than selecting the portfolio here, I'm going to select the portfolio on this orange line, because if you look at it, this is offering more returns for the same level of risk. And over here I can select this portfolio as compared to this portfolio. This return is higher as compared to the efficient frontier. So that's what happens when we combine the risky assets with the risk-free rate. We get a straight line, and that's we call as CML. And this market portfolio is the point where it's tangent to this straight line. That's what we call as the market portfolio. Also, due to homogeneous expectation, now there's one assumption here that we are assuming that everyone will have the same line, and so we just have, hence we say that we just have one CML and one market portfolio. And CML, and this is the equation to calculate the expected return on the portfolio via the CML. It just says that you add the risk-free rate to the overall excess return that you get from investing in this market and the standard deviation of the overall portfolio. But even more important than this CML equation is we have something known as capital asset pricing model. And just to let you know the importance of CAPM, you can see there are 4 learning objectives that talks about CAPM. Okay, so it's something that is very important when we are talking about this particular chapter. Now talking about CAPM, capital asset pricing model, it provides a way to calculate the asset's expected return based on its level of systematic risk, which is also known as market risk, and which is measured by this beta. Alright, so this is the formula for CAPM, and it says that to calculate the expected return on any asset, let's say that if I want to calculate the expected return on ABC company, okay, I first need the risk-free rate. Let's assume the risk-free rate is 3%. Then I need the beta. Now what exactly is this beta? Beta is the stock's sensitivity to the market. So consider this situation to understand beta. Let's say that the stock that we have is ABC and the beta is, let's say, 0.7. So if the market, the overall stock market, if it goes up by 100 points, the ABC stock will go up by 70 points. Okay, so that's what we mean by beta. It's the sensitivity to the market, the relation, the overall relation to the market. And let's say if the beta is 1.5, then if the market goes up by 100 points, the ABC stock will go up by 150 points. So this is how beta is actually related to the market. It is the sensitivity of the stock to the market. Alright, and continuing with our example, let's say the beta is 0.7 and the expected return on the market is, suppose it's 8%. And the risk-free rate is already 3%. So once I calculate this, I will get a number, and this answer is the expected return on this ABC company. Okay, so capital asset pricing model, it gives you this particular formula to calculate the expected return on any individual security or a portfolio. All right. Now, I would like to add one more point here, that this thing that you see, the expected return on the market minus the risk-free rate, this is referred to as equity risk premium. Okay, you sometimes on the question you may have the expected return on the market and you may also have the risk-free rate, so you can calculate it. Other time it is also possible that you are given this equity risk premium of, let's say, maybe 2%. So you don't necessarily have to calculate this. Just take the risk-free rate plus beta multiplied by this equity risk premium. Okay, this is also referred to as equity risk premium. Moving on to beta interpretation, we have already talked about this. Is the stock sensitivity to the market. This is how you actually calculate the beta. Okay, you need the covariance of the I. Now over here, this I represents the asset and this is the market. So covariance of the asset and the market divided by variance of the market, you get the beta. If covariance is not given, you can use this particular formula, and this is the correlation of the asset I and the market multiplied by this standard deviation of the asset divided by standard deviation of the market. Okay, so this is, now honestly on the exam you'll not be asked to calculate the beta. It's not going to be that simple, but also understand that this is how it's calculated if beta is not given, and probably you may have to calculate on the exam. But what I feel is you will be given all these details, you just have to plug in the numbers correctly. Okay, talking about beta, the beta of market is always 1. Okay, I want you to remember this thing, the beta of market always 1. Okay, because understand, if we are comparing the market and the market, if the market is going up by 100 points, of course this is also going up by 100 points, right? So the beta of market to the market is always 1, and let's say that beta is greater than 1, as in our example we took 1.5, so we can say that ABC is an aggressive stock, and if the beta is less than 1, let's say maybe 0.8, then we can say that ABC is a defensive stock. Okay, so this is something that you just need to remember for the exam. Talking about the derivation, now what I feel is derivation is something that the GARP will not ask you to derive the equation on the exam day, but understand we have this regression equation, and with the help of this regression equation we have actually come up with this formula of the CAPM. Okay, so that's what we have that's what the entire derivation talks about. Okay, and over here look at the particular diagram, it looks familiar to the CML. The only difference is that the orange line that we have here is referred to as security market line. Okay, it's not CML, it is SML, security market line. The x-axis here, it considers the beta. Remember, when we're talking about diversification, I told you that this risk reduces, but there is some element of risk involved, and that is the systematic risk. You cannot diversify that. So CML actually considers the entire standard deviation. Okay, and the SML, it actually considers only the systematic risk. So that's the only difference that you need to understand for CML and the SML. Okay, moving on to the assumptions of CAPM. The very first assumption is that information is freely available. The second information is frictionless market. That means there are no taxes, no commissions. It ideally does not happen today. Assets can be divisible. You can divide the assets into as much fractions you want. Market participants can borrow and lend at the risk-free rate. Again, this is one major assumption. Investors decide solely based on expected returns and variances. So it also assumes that only returns and variance play an important role. What about skewness and kurtosis? Again, no problem, this is just an assumption. And finally, the last assumption is that it has homogeneous expectation, same forecast of expected returns and variances for you and for myself. Okay, what you think, I may think the same. That's what the homogeneous expectations mean here. So I've got an example here which will actually help you to calculate the CAPM. So let's say that you're required to calculate the let's say that you are calculating the required return on the stock of Vardy's Inc. by using the CAPM model. The risk-free rate is given to be 6%. The return on the market is 8%. The beta of Vardy's is 1.2. Alright, so let's see the calculation. So the expected return on Vardy's equal to the risk-free rate, which is 6% plus 1.2. This is the beta, and this is the equity risk premium, which is 8% minus 6. So once you calculate this, you will get 8.4% as the required return. Sometimes this required return is also called as the hurdle rate. So if don't get confused on the exam, if they ask you to calculate the hurdle rate, that means one and the same thing, also known as the expected return. Because alright, now finally the last learning objective, and that is calculate, compare and interpret the following performance measures. Now when we're talking about the performance measure, they are actually a way in which you can actually find the performance of the portfolio manager. So basically, if you want to quantify how your portfolio actually performed to a benchmark, so you can calculate one of these performance ratios. Okay, so the very first and perhaps one of the most famous is the Sharpe Performance Index. Now it calculates the excess return per unit of total risk. Okay, so what it does is that it takes the expected return on the portfolio minus the risk-free rate, so this is referred to as the excess return, divided by the standard deviation, or also known as the total risk of the portfolio. So let's say the expected return on the portfolio is 10% and the risk-free rate is let's say 6%. So you have earned 4% excess of the risk-free rate. Okay, and you divide this by the standard deviation of the portfolio and you get your Sharpe Performance Index. Alright, talking about Trainer Performance Index, it also calculates the excess return, but the only thing is that the denominator is now the systematic risk, also known as the beta of the portfolio. So it is quite similar to the Sharpe, only the denominator is changed. And one important note is that for a well diversified portfolio, Sharpe ratio will always be equal to the trainer ratio, because if, for example, if the portfolio is well diversified, the only risk that will remain is this beta. Okay, so the total risk will be reduced to beta if the portfolio is well diversified. And one thing I also want you to remember about the trainer and the Sharpe, make sure that you remember this: not diversified, you would use the Sharpe Performance Index, and if it is diversified, then you would use the trainer ratio. Okay, so this is something that I want you to remember for the exam. Now moving on to the Jensen's Performance Index, it compares the portfolio expected return to the CAPM. Okay, it's very simple. You have the expected return on the portfolio, you subtract it from the capital asset pricing model. Okay, so rather than having the risk-free rate, it has been replaced by the CAPM, and if this Jensen's alpha is positive, it is undervalued and you should buy that security or that portfolio. Also, if the trainer measure is superior, then this automatically implies that Jensen's alpha will also be superior. So if you calculate the trainer performance index, if it comes higher, then of course Jensen's performance index will also come higher. Okay, and one very important thing is that for the Sharpe performance, for the Jensen's performance, and for the trainer ratio, the higher the better. Okay, so this is something that is good to remember for the exam day. Now before we talk about this tracking error and information ratio, I want to touch upon this Sortino ratio. Basically, Sortino ratio is similar to the Sharpe ratio, except that we have removed the risk-free rate, some minimum return required, and the denominator here is some downside deviation. Okay, so these things will actually be given on the exam. You just have to plug and solve the answer. Okay. Alright, talking about tracking error and information ratio. Now tracking error is simply the difference between the portfolio's return to those of the benchmark. Okay, you take the return on the portfolio less the return on the benchmark, and that's it. Over here we do not have risk-free rate, we have some benchmark which we were tracking. So this is something that you need to remember. Information ratio is calculated as the excess return of a portfolio over the benchmark standard deviation, and the denominator is tracking error, or on the exam, if you're given the active return and the active risk, then this is the numerator and this becomes the denominator to calculate the information ratio. Okay, so these formulas are very important. Make sure that you go through it once. Alright, moving on to the next chapter, which is quite similar to the last chapter that we have seen, and that is the APT model and multi-factor models of risk and return. Okay, so in the last chapter, what we actually saw was capital asset pricing model. Now capital asset pricing model, they are actually the one factor model. Okay, we have the risk-free rate, then we have the beta, then we have the equity risk premium. Now this equity risk premium is calculated as the expected return on the portfolio minus the risk-free rate. Alright, so over here you can see that there's only one factor, which is this market factor. Okay, so this is a single factor, or we can say that it's a one factor model. But when we are talking about the arbitrage pricing theory, okay, what we are saying is that arbitrage pricing theory is a multi-factor model, and it measures the returns on an asset as a linear combination of multiple risk factors. Okay, so basically let's say that I have this stock ABC. Now what I feel is that it's not just affected by the market, but there is also one factor that this stock is very much sensitive to, and let's say that factor is probably GDP. If the GDP goes up, then this stock is also affected. And similarly, I can also say that this stock is also affected by the fundamentals of the company. Okay, so let's say the price to earnings ratio. Alright, so this PE ratio, that also affects ABC returns. So now I can say that this ABC and the market factor is just CAPM. And if I include the other two factors, I can say that the entire thing becomes multi-factor model, or I can say arbitrage pricing theory. Okay, alright, so what APT suggests that multiple factors can help explain the expected rate of return on a risky asset. Now look at the formula. The return on the asset I, okay, the return on any asset, let's say ABC, that is equal to expected return on I, the expected return on the ABC. Now this expected return on ABC is actually CAPM, and then we have these different factors up to K. Okay, we can have multiple factors as much as we want. Alright, that is absolutely up to the analyst. So this E represents something that is known as the company specific risk. Okay, something that is not being captured by this entire model. Whatever the error is there, that's what we have it here in the end. Alright, so here we have the notation. The expected return on I is the expected return on the stock. This is basically the CAPM. The beta of K is the betas of all the factors that we have here. So it's the sensitivity of these factors. Now F here represents the risk factors. Now how do you calculate these risk factors? This is an important calculation. You first see the observed value minus the expected value. Now remember this. Now hold on to this. I will actually solve one question for you so that you understand all these things, and this will all make sense. Okay, E is referred to as the company specific risk. Alright, now APT doesn't tell us which factor should be included. So understand, I can include GDP as one of the factors. See, market factor is already here. Okay, that's already included in the CAPM. I can include GDP if I want. I can include PE ratio. Maybe if I want, I can include inflation, some other factor that may affect my stock. Alright, so APT, it provides flexibility. However, the core of the APT model is to find the combination of granular risk factors that more closely predict the return of a financial asset. See, you can have n number of factors, but it's important that you limit the factors and include only those factors that actually affect the returns of a particular asset. That should be the ideal goal of using the APT. Now the learning objective actually talks about APT, compare the APT to the CAPM. So CAPM is a single factor model that describes an asset expected rate of return as a linear function of the market risk, only the market risk, and has only one beta, that is a market beta. Okay, here we have multiple betas up to K. We have multiple factors up to K. Okay, and as you can see, the expected return on I, which is here, the expected return on I, that's what we have it here. So that's why I say that it's CAPM. Okay, all right, talking about the assumptions of APT, there are no arbitrage opportunity. I mean, of course, it's arbitrage pricing theory, so there shouldn't be any arbitrage opportunity. This is the very first assumption. By using diversification, investors can eliminate the company specific risk from their portfolios. We've already seen this in the last reading. And asset returns can be explained by systemic factors. So these are the assumptions that we need to know for the exam. All right, next learning objective: describe the inputs that goes into a multi-factor model and calculate the expected return of an asset using a single factor and a multi-factor. Now what I've done is that I actually used a simple example. I just thought, let's take an example so that we understand the inputs and everything in a much better way. So the example is, suppose we are using the APT model now to calculate the return on Vardy's Inc. Now the stock is very sensitive to GDP and the inflation index. Okay, we are given these two factors as well. Now the consensus GDP was 2.5%, but the actual GDP was 3%. Now I told you here, if you look here, to calculate the F or these different factors, you need to first have the observed value minus the expected value. Okay, what we expected is here and what the actual or the observed value is here. Okay, so this is something that you must remember for the exam, to calculate all these different F. If the F is already given, that's a good situation, but if it is not given, this is how you go ahead and you actually calculate it. Alright, so here we have to calculate the F or the factor, the GDP factor basically. So the consensus GDP was 2.5%, the actual GDP was 3%. So the GDP, the factor GDP would be, what is the actual GDP? Actual is 3% minus what was the expected is 2.5%. So that is going to be 0.5%. Okay, so this is the factor GDP. Similarly, I have the inflation surprise factor, which is actually given as 1.6. Okay, now what do we mean by surprise factor? Now surprise factor is something that is already calculated, you don't have to calculate it. So what do we mean by surprise factor? So this, the final answer that we get after calculating all these things, that is also referred to as the surprise factor. Now here the inflation surprise factor is already given as 1.6%. the risk-free rate is 6%. So let's just take this example. So here we have the APT model here, and let's just calculate that. So return on I, here we were calculating the return on Vardy's Inc. So the return on Vardy's, now on this example here, if you read, the CAPM is actually not given, so we have to calculate it from scratch. Okay, I've deliberately included that thing so that we also calculate the CAPM. So okay, here we have the risk-free rate, then we add the beta of the market. The beta market risk premium is 2%. We are already given the equity risk premium, and here we have the beta. Okay, the beta of the market is 0.75. okay, so by this we calculate the CAPM plus the first factor, which is the GDP. The actual GDP was 3%, 2.5% is the expected value. We subtract this and we multiply that with the beta. Okay, the beta of GDP, okay, the factor beta for GDP is 1.5. okay, and similarly we have the inflation is here, the factor, and the beta of the inflation is 2. And finally we have the company specific risk, the E is actually given to be 1.1%. Alright, so once we go ahead and once we solve this thing, we get these, and finally we get the answer as 12.55%. Alright, moving on to the next learning objective. Describe and apply the Farmer French 3-factor model in estimating asset returns. Now so far APT doesn't tell us which factors to use. So what these Farmer French, the Eugene Farmer and Kenneth French, what they did is they actually specified a multi-factor model with 3 factors, because APT doesn't tell us which factors to include or probably to exclude. So here what they defined is that they had their own 3 factors that should be included in a multi-factor model. So they have already pre-decided those factors. The very first one we have is the return on the market risk premium. So market is the first factor. The second one is the SMB. Now SMB is basically small minus big. Okay, so the returns on small firms minus the returns on large firms, we get the SMB factor. So this is the second factor that they have suggested. And the third factor is HML. Now this HML is high minus low, that is returns on high book to market companies minus the returns on low book to market companies. So this HML becomes the third factor, and whatever the return that is not captured by all these factors, we have the error or the company specific risk. So these three factors are something that has been specified by the FAMA French. Alright, now this learning objective explain how to construct a portfolio to hedge exposure to multiple factors. Now understand, with the help of diversification, non-systematic or any company specific risk can be removed, we know that, but it's not possible to eliminate the systematic risk that is present in any factor. Okay, so what can be done is, as an analyst, if I want to hedge a particular systematic risk, I can use these factor betas, I can hedge the betas, and I can construct my own hedging strategy to remove any systematic risk that I want. Okay, I'm going to give you an example to understand this. Now consider this example to understand this hedging exposure. Suppose I have this portfolio which I have this ABC stock. Now this particular stock is exposed to GDP and the inflation, and as an analyst I don't want any exposure to the GDP. The exposure, the sensitivity of the beta is 0.5. so this is the sensitivity, the beta sensitivity of GDP, which is 0.5. So what I can do is, in order to negate any effect of the GDP, I can buy another stock. Let's say we have this XYZ stock here, which also has the beta sensitivity of the GDP, which is 0.5. So what I can do is, if I am long, if I have already bought this thing, I can short this another stock, and effectively what will happen is both the GDP will actually cancel out. Okay, the sensitivity of the betas, they will actually negate each other, and this is how I am now exposed to only the inflation beta sensitivity. Okay, so inflation going up and down will have the effect on my stock. GDP going up and down here or here, they both will negate each other. Okay, so this is how, if I have multiple factors, I can find any combination of portfolios and I can make a hedging strategy. And this is a wonderful thing about multi-factor models, wherein you can go ahead and you can expose your portfolio to certain risk factors that you want as an analyst. Okay, so that's what this thing is all about. And there's also a concept of factor portfolio. So this factor portfolio is a portfolio with a factor sensitivity of 1 to a particular factor and 0 to all the other factors. So for example, I could have this portfolio, let's say, which has the beta of the GDP of, let's say, 1, and then all the other factors, maybe the beta of the PE ratio, that could be 0, then probably the beta of maybe inflation, that could be 0. So having the beta sensitivity of 1 to a particular factor and 0 to all the other factor, that is what we mean by a factor portfolio. And finally, moving on to the last learning objective, well, APT relies on a well diversified portfolio. See, it's crucial to understand this to get better correlations in our portfolio. The asset, if they all come from the same asset class, let's say if I'm buying 2 stocks from the same industry, if the entire industry is going up, then my stock will also go up. But if the entire industry is going down, then both the stocks will go down. So that's not a right way to have correlation in my portfolio. Okay, so to get the benefit of correlation, the asset should be sourced from different asset class, because if one industry goes down, probably the other may go up. Okay, so I'll have much better diversification. So therefore, a well diversified portfolio will hold asset from different categories. This is something that you need to know for the exam. Alright, moving on to the next reading number 7, principles for effective risk data aggregation and reporting practices. Now what this chapter is all about, it gives out 14 principles that has been set up by the Basel Committee on Banking Supervision. Okay, so we're going to be looking at all those 14 principles. Okay, so let's just get right into it. The very first thing, what are the potential benefits of having effective risk data aggregation and reporting? Now, according to the Basel Committee on Banking Supervision, risk data aggregation means you define it, gathering and processing of the risk data according to the bank's risk reporting requirements, so that it enables the bank to measure its performance against the risk tolerance or the risk appetite that has been set up. Okay, so this is the formal definition. Talking about the potential benefits of RDARR, well, the very first thing is increased ability to anticipate problems. You can anticipate the problem in a much better way if you have effective risk data aggregation and effective risk reporting. Okay, when the data is aggregated as a whole, when you see the big picture, you can anticipate the problems in a much better way. You can identify routes to financial health. Now this is also important. If you know what exactly the company is facing, what risk the company is facing, you can actually work upon that quickly. Improved resolvability in times of bank stress increases the overall efficiency, reduces the chance of losses, and also increases the profitability. So these are some of the benefits as well. Alright, moving on, describe the impact of data quality on model risk and model development process. Now when we're talking about effective risk analysis, okay, when the risk analysis is effective only when we have good quality data. Okay, so the data quality plays a very important role. This actually supports the effective risk management. Okay, so financial companies, they use data in their day-to-day operations, and they use different models, they create different models, and they use that, and the data that they use should be of good quality. This goes without saying, because if the data is incorrect, this can lead to input risk. Okay, this is a major risk, because the inputs that you put into your model, if the input is incorrect, so the model will give you incorrect estimations. Okay, so which will indirectly make our model go faulty. So for any model to work, data is of significant importance. Alright, okay, and it was actually observed by the BCBS that the data quality in the banking industry was actually inadequate to aggregate and report risk across the business lines, legal entities, and at the bank group level. Okay, the data that they had, that was very much inadequate to aggregate and report risk exposures. Hence BCBS, they created these 14 guidelines or principles that we will talk about. Okay, let's look at the principles now. So the principle number 1 is governance. Now this goes without saying, governance is very important when you have any implementation in your organization. Okay, so this principle, what it says is that strong governance framework and independent validation is needed to make sure the risk data aggregation reporting practices or capabilities is functioning properly. You should have a mechanism or a framework in place so that you ensure that the capabilities that is needed for risk data aggregation and risk reporting is functioning properly. Board, they have a role to play in governance. Now this goes without saying that board, they have to play a very important role in making sure in creating a strong governance framework, and the board should also ensure that appropriate resources are available. For example, if a team or any human resource is needed to manage the governance or to create a governance framework, then the board should ensure that resources are available in terms of that. So that's the role of the board. The RDAR policy should be reviewed and revised if there are some major acquisitions or any changes in strategy. If the company has done major acquisitions, then the RDAR, then risk data aggregation policy probably should be revised, or if there is any changes in strategy, they should go ahead and they should revise that. Alright, so that's the first principle. It talks about governance as a whole. Moving on to the second principle, data architecture and infrastructure. Now data architecture is the way in which you collect the data, you store it, you process it, and so on. So having the infrastructure, the proper implementation of the data architecture is very important. Okay, that this is very crucial for any organization. So principle number 2, what it suggests is that it should fully support its risk data aggregation capabilities and risk reporting practices, not only in normal times but also during times of stress or crisis. Now during the time of stress and crisis, there's a lot of data that is needed to actually come out of the stressful situation. So having your risk data aggregation or risk reports in such a way that it works not only just in normal times, but it can also support during the stress time. Okay, firms should establish integrated risk data architecture. This is recommended that they have integrated risk data architectures across all the business lines. All the people who are handling data, their roles need to be clearly defined. Alright, so this is another that has been recommended. Okay, now the principle number 3, 4, 5 and 6, it actually focuses on what could be the characteristics of risk data aggregation. The risk data, when you aggregate it, okay, what should be the ideal characteristics? These principles will focus on that. Okay, so principle number 3, accuracy and integrity. Now principle number 3, what it says is that the data aggregation should be accurate and reliable at the same time, and this accuracy and the reliability should be there not just in normal times but also during the times of a stress or a crisis situation. And banks should focus more on the automated basis to aggregate the data. When they are aggregating the data, automated is the most preferred way. So you use this manual way only when the professional judgment is needed or human intervention is needed. You go ahead and you use the manual way. And if the manual or automated, whatever way that you use to aggregate the data, document that and explain when there are manual workouts. If you're using manually to go ahead and aggregate your risk data, then you need to document as well as to explain why the manual was used as opposed to the automated one. Okay, principle number 4, it talks about completeness, and risk data should be complete. There should be proper reconciliation of the data, and it should be complete in such a way that it should include all the material risk, even at the granular level. Okay, the risk data should have even small, now granular means smaller, okay, minute details, so even granular level details, so that bank should be able to capture and aggregate all the material risk data across the banking group. Okay, so it should be complete so that it allows the bank to capture and aggregate all material data. Okay, all right, principle number 5, it talks about timeliness. Now of course you need timely data so that the banks can make decisions quickly. So risk data aggregation should be timely and should meet all the requirements for risk management reporting. Okay, it's not just that you have to produce timely data and in a hurry you produce anything. They has to meet all the requirements for effective risk management reporting, and there should be systems in place to produce the aggregated risk data quickly in times of stress or crisis. See, as we talk about these principles, we see that there has been a lot of emphasis about being all the data aggregation and risk reports to be very helpful during the times of a crisis or a stressful situations, because that is when the banks actually need the most. Okay, so it's very important that it has to be complete and timeliness. All right, so it's very important in terms of that. The degree of timeliness varies depending on the business line. Now this is absolutely true. For example, a trading desk, they may require the data very quickly. The other department, they may wait for certain time. Okay, so it totally depends upon the business line. And principle number 6 is adaptability. Now data aggregation capabilities should be adaptable, this goes without saying, and the data aggregation should also be flexible and should be available for ad hoc data request. So ad hoc is something that as and when it comes up. Okay, you can have ad hoc whenever that the data is needed. Okay, the data aggregation should have such kind of capabilities that it can handle all the requests as and when it comes. Okay, so that the bank can assess any emerging risk. A bank should be able to pull out specifics from aggregated risk data. As I said, adaptability has also to offer any specific information that the bank or the bank management is looking out or the board is looking out, then the bank should be able to pull out the specific details from that particular data. Alright, now talking about the characteristics of risk reporting practice. Now the principles that we will see from 7 to 11, it shows the ideal characteristics of risk reporting. Okay, so principle number 7, it's accuracy. Now this accuracy and this accuracy, they're different. Okay, this was the characteristics of risk data, the ideal characteristics of risk data, but here we have the ideal characteristics of the risk reporting. Okay, so they are both different, and that's why we have got another principle. So what it says is the risk reports, they should be accurate and precise. With the help of these reports, senior managers and the board, they should be able to use the report so that they can make critical decisions about the firm. And finally, risk reports, they should also be validated. Okay, validation of the reports is necessary, and only then the decision making will be done. Talking about principle 8, which is comprehensiveness. Now, risk reports, they should contain the information regarding the position and the risk exposure the company is facing, such as the credit risk, liquidity risk, the market risk, and so on. Risk reports, they should be forward looking, and they should also include the forecast that will be used and also the stress test that has been done. Risk reports, it should be complete so that it gives out all the details that is needed for the firm's operations. All right, so it should be complete in such a way that it should cover all the details necessary, even if the size is small or large. Okay, and this comprehensiveness should also meet the requirements that has been set up by the board and the management. Now, principle number 9, it talks about clarity and usefulness. So reports, they should be tailored to the end user. Now, managers, they use the report, the board, they will use the report, risk committee members, they will also use the report. So the report should be tailored to meet the end user. It should meet their requirements, and report should also explain information in a clear and concise manner. Only understandable report that is easy to understand will help us allow the management or the board to make decisions. All in all, it should not be so difficult to understand. So that's where the utility of the report will make a difference. Principle number 10 talks about frequency. Now, the frequency of the risk report, that is how often you produce the risk report, how often you distribute the risk report. So this frequency should be set by the board and the management. Also, the frequency will vary depending upon the recipient, the type of the risk, and the purpose of the report. So these things will also decide the frequency of reports, and especially in stress crisis periods, risk reports may be required on an urgent basis in order to react to the mounting risk. Then we have principle number 11, which is distribution. Now, risk report, they should be distributed or disseminated in a timely fashion while maintaining confidentiality wherever required, and at the same time, reports should be delivered to the recipients in a timely manner. Now, just to produce timely reports, it's not that you compromise on the confidentiality. So this is something that needs to be taken care of, and also the reports should be delivered in a timely manner. Now, as I said, the stress or crisis periods, that is when we need the reports the most. It should be delivered to the recipient in the most timely manner. Alright, the role that the supervisors, they play in the monitoring and implementation of the RDARR. So principle number 12, 13 and 14, it will talk about the role that the supervisors need to play. So principle number 12 is reviewing. Supervisors, they will review and evaluate the bank compliance with all the principles that we have just spoken about on a regular basis. Okay, so they should review. That's the first responsibility. Remedial actions and supervisory measures. Now, this is principle number 13. So supervisors, they should have various tools available to them so that they can address any risk data aggregation and any reporting deficiencies if they occur. Okay, so any sort of deficiency occurs in the data aggregation and reporting, the supervisor should have the tools available. Supervisor should set the expectations on timing and effectiveness of any remedial actions that needs to be taken, and be able to revise actions if the known deficiencies are not appropriately addressed. Okay, finally, the last principle is about cooperation. Now, cooperation is expected from the supervisors with other relevant supervisors regarding the review and implementation of all the principles and any remedial action deemed to be necessary. So basically, it's all about reviewing and taking some remedial actions and cooperating with the other supervisors. So that's their role. With this, we end the 7th chapter. Let's move on to the next reading. Now, This is going to be the last reading for this revision. Now we are not doing chapter number 11. The reason for that is I want you to read word by word from either GARP that you're referring or any other book that you're referring to. So make sure that you read it, understand it. Okay, the code of conduct is very important. You can expect 2 to 3 questions on that, but we cannot summarize that. There cannot be much summarization that can be done out of that. So it's really important that you read it word by word, understand it, and then go to the exam. Alright, so reading number 8, ERM and future trends. Now ERM is basically enterprise risk management, managing the entire risk on an enterprise level. So looking at the big picture, that's how we can summarize the ERM. So the first learning objective, describe ERM, compare an ERM program with a traditionally silo-based risk management. So here is the example of a silo-based approach, and here I've drawn the diagram of an ERM approach. Let's first understand what happens in a silo-based approach. We have different departments. These are known as silos. Okay, all these cubicles, or all these departments, I would say, they are all silos, so that's why we call it a silo-based approach. Over here you will find isolated risk managers. Okay, there's one risk manager in market risk, there's one in credit risk. So these risk managers, they are very much isolated. On the other hand, if you look at the ERM, now you would see that all these different departments, okay, they also have risk managers, but they are all integrated. Okay, they are integrated and they report to one person, that is Chief Risk Officer. He's part of the risk committee and he's responsible for all these risk managers. Okay, so this is why they are integrated. Now over here they manage risk within business lines. So within their own business lines they will consider their risk. Okay, but over here they can see risk across all business line, and this is very good because you can actually consider the diversification of risk as well. If this is facing more risk and perhaps the market risk is also facing that risk, so there is a diversification benefit in risk as well. All right, so this is very good when it comes to ERM. Talking about multiple risk metrics, yes, probably he may be using VAR, the credit risk may be using some other credit risk models, they are using some other models, so there is no integration in risk metrics as well. Over here there is an integrated risk metric, not possible to see aggregated risk. So you really do not have a big picture of the whole risk that the company or a bank is facing. Over here you can consider that the entire risk is visible. You have a big picture in mind. Alright, so you can appreciate that you can see the aggregated risk, and this is very important. We have already seen the chapter on the aggregate data and risk reporting, so it's very important. Risk management is not integrated. Risk management is integrated with strategies of the firm, so you can actually decide much better strategies with ERM in perspective. So that's what we mean by that. Talking about the next learning objective, benefits and cost of ERM. So the very first benefit is that it helps to define the risk appetite. The board find it to be very easy to consider or define the risk appetite on an enterprise wide basis, and they can focus on largest threats to the firm. Absolutely true. You know what is coming, so you can work on that. Cost of transferring risk is better managed with ERM. Absolutely, you can transfer, you can mitigate your risk, you can transfer it to a third party. You know the diversification, so the cost is actually reduced with the diversification and the correlation of risk. Okay, helps managers understand correlations between risk type. This is absolutely true. You understand the correlations, you take benefit of that. ERM supports regulatory compliance and thus reassuring to stakeholders of the financial institutions. So regulatory compliance is also being supported by having ERM in your organization. So this sends a good message to the stakeholders as well. Cost, the implementation of ERM is time consuming. See, moving from a traditional silo based to the ERM, it takes time. Okay, it's take time. There's going to be full level implementation in the organization. So overall, it is time consuming and costly as well in terms of capital and labor. You need human resources involved, so it does take time and it is costly. Also, it needs continued support from the management and board. As I said, any implementation in the organization, the board and management, they have a pivotal role to play. Best practices for the governance and implementation. In successful implementation of ERM, management and board, they play a very pivotal role. Hence, management should remain committed to the risk initiatives that they take, and they should ensure that the firm has the required risk management skills. If you do not have required risk management personnel, hire them. And organizational structure as well to successfully implement the ERM program. Okay, so this is also important. Having a proper oversight, the audit and monitoring the targets are also crucial components of the ERM governance process. Okay, moving on to the next learning objective, describe important dimensions. Now, essentially what we are saying is that when we are applying the ERM into our organization, when we are practically doing that, there are 5 important dimensions that needs to be taken care of. The first one is targets. Now here, banks, they should have the right risk targets, which should actually focus on including the risk appetite, but on an enterprise-wide basis. Okay, so the risk appetite the board will prepare, they should focus on the overall enterprise, and this should not conflict with the strategic goals of the firm. Okay, there shouldn't be any conflict with the overall strategic goals of the business. Talking about the second dimension, and that is having a proper ERM structure. Now, talking about structure, this will actually form, or it will actually cover the role of the relevant parties. Okay, for example, the CRO will have a specific role to play in the overall ERM implementation. Board will have to play the role, and all these roles should be there along with the description of the firm corporate governance structure or framework. Corporate governance structure should also be there. Then we have identification and metrics. Here the goal is to find which metrics will best capture the enterprise level risk, the entire company wide risk. Which metric should be used, that's our goal. In identification, managers should also check for any concentration of risk. If 2-3 departments are facing one similar risk, then that's what we define as concentration of risk. So they should check for that, and appropriate risk metric should be used. ERM strategies. Now over here, the firm will have to define the methods and the strategies that will be used at the enterprise level or at the business line level. So basically, if the management has decided they want to retain the risk, they want to avoid the risk, what should be the strategies to mitigate or probably to transfer, all those will come on an enterprise-wide basis in the ERM strategies. And lastly, we have this culture, which we're going to talk in the next learning objective. A strong risk culture is very important for ERM. A firm should create a culture giving importance to risk management via the behaviors of the management, their decisions and practices of the overall firm. So culture is crucially important. All right, next learning objective, risk culture, characteristics of a strong corporate risk culture and challenges that we see in risk culture. Well, talking about risk culture, it's something that tells us a lot about the firm. What are the goals of the firm? What are their values? What are their beliefs? How the staff in a firm, they think or manage risk within the organization. So all these things, it influences the behavior of employees, both in implicit as well as explicit ways. Okay, so that's what we define as risk culture. Now, developing a risk culture or establishing a strong risk culture is difficult because it is multi-layered. Because see, understand, people come from different backgrounds, they have their own risk mindset, and these are driven by their own personalities, their personal experiences and so on. So that is why it is important to establish a strong risk culture, but it's quite difficult. Talking about the characteristics of a strong risk culture, what are the indicators? Well, the first one is tone from the top of the organization. By having a look at the tone from the board and the management, you'll try to figure out whether the risk culture is strong or weak. To give you an example here, we can see whether the stated risk goals and the risk appetite, are they conflicting with the actions of the management? Do they work in alignment of the risk appetite, or they deviate from that? The other example could be the compensation plans. Does the compensation plan of the firm, do they encourage risk taking behavior? So these things will help you to identify the tone of the top management. The next indicator for a strong risk culture is effective communication and challenge. Now here we check whether any person may have an opposite view, they may have differing view of what management thinks. So is that opposing or differing view being valued? So this is how we find in this particular aspect, and this also lets us understand the risk culture in an organization. Talking about incentives, here we check the compensation plans and whether the risk appetite is being followed, or people simply look out to take more risk to get more compensation so that they can earn more incentives. And finally, the last indicator is accountability. Are people in the firm, are they held responsible or accountable for their actions? Basically, expectations have to be clear. Okay, talking about the challenges for a strong risk culture, the very first one is risk indicator or risk lever. What is it? See, management, their responsibility is that they should identify risk indicators so that they can manage the risk properly. Okay, but sometimes managers, they find it to be more easier to manage or probably to manipulate an indicator rather than finding the risk indicator itself. So that's why risk indicators, you find it becomes the risk lever, and that this is a major challenge for establishing a strong risk culture. Second is education for everyone. Here what we say is that risk education is not just for employees. It is important that even the board of directors, they should have sound risk knowledge, and this could sometimes become a challenge. Third, we can see time and space. It has been observed that risk are generally established in the business lines and not at the entire enterprise level. So the enterprise, they should have some mechanism in place so that they can identify the risk that comes up in all or probably across all the business lines, and sometimes they may appear in multiple business lines as well. So have a mechanism in place so that they can identify the risk that can be seen across the business lines. Talking about the cycle of the culture, what we are saying is risk culture is, it has a particular cycle. It's more evident in times of crisis, and the feelings and the fears that we see during a crisis period, that actually fades over time. So the risk culture, they have their own cycle, and this could be one of the challenge as well. Curse of data. A lot of data is available for analyzing the risk. Sometimes it becomes difficult, and as data become more plentiful, firms, they may have to employ machine learning to get some useful insights and conclusions from the plenty of information that is available out there. So having such huge data can be a challenge for identifying the risk indicators and to actually incorporate the risk culture. Alright, the role of scenario analysis in the implementation of an ERM program. Let's first have a look at sensitivity analysis first. Here we change only one variable. Let's say we are changing revenue and we are seeing the impact. What could be the possible outcome? We just see the impact. Where do we stand by changing just one variable? In scenario analysis, what we do is we develop multiple scenarios. We change multiple variables, okay, for a particular risk factor, and then we check for the outcomes. So we may have the base case, we may have the worst case, and then we figure out whether can we bear that worst case losses. Okay, so scenario analysis, it talks about that. Now we know VAR models, they have their own shortcomings. They doesn't tell us losses beyond this particular VAR level. So scenario analysis, it actually becomes an important tool where the firm can imagine company-wide scenarios, and this will ultimately help in the ERM risk identification. Talking about the advantages of scenario analysis, it may be forward-looking. If you want to have a look into the futures, you can develop scenarios that are forward-looking. You can use hypothetical events, okay, or maybe you can use some historical data, a crisis situation, and you can develop scenarios based on these events. So it's up to us. So that is why it's an advantage. It may also be used to develop a firm's risk appetite. You can develop multiple scenarios on your risk appetite as well. You can set your risk limit, and also in capital adequacy planning. And this is something that we're going to be talking about in the next learning objective. While talking about the disadvantages, scenarios can become complex at times because it is very difficult to gauge the probabilities of events. You may have a particular scenario, I may have a particular scenario. So it's really hard to identify which one will work, and scenarios may still underestimate the impact of an extreme loss. This is absolutely true. Now, it's really difficult to actually identify the impact of any particular event. Finally, the last learning objective for this foundations of risk management, and we are done with the revision. Explain the use of scenario analysis in stress testing programs and in capital planning. Now, before the financial crisis, what used to happen is that banks, they used to build their own scenarios. They probably used real life historical events, like, or any kind of financial crisis that happened before the 2007 and 2009. So they used to look at historical events, and then they used to decide, okay, that this much is the capital that we will go ahead and we will keep aside based on the past. However, it was not clear to banks how many historical scenarios to use, what should be the hypothetical scenarios, what could be the possible scenarios to build. So that was not clear. So as part of the healing process towards the end of the global financial crisis that we have seen, the US stress test, so they began with this initial supervisory capital assessment program, this CAP, which was conducted in May of 2009. Okay, and two things were recommended. The very first thing is the Dodd-Frank Act stress test. Okay, so this is also a stress test which are conducted in the middle of the year for all the banks with assets above $10 billion. So if a bank has an asset worth $10 billion, they will do this Dodd-Frank Act stress testing, okay, DFAST. They'll do that in the middle of the year. And if a bank has an assets above $50 billion US, then they will do this thing, comprehensive capital analysis and review, CCAR, okay, which are conducted at the end. Okay, this one is at the middle and this is at the end of the year. Talking about DFAST and CCAR, DFAST, it requires less reporting, requires limited capital action assumptions. Okay, so this is a benefit for DFAST. CCAR requires projection over a 9-quarter horizon, and it is quite complex. It also requires bank to dynamically forecast their balance sheet and income statement items. Okay, so you have to forecast your balance sheet and income statement items for a 9-quarter horizon. So it's quite complex, and banks, they should also submit the capital plans based on each the scenarios or the stress test they will do. Whatever stress test or scenario analysis they will perform, they will have to submit the capital planning based on these things. And for each scenario, banks must show that they can maintain minimum capital standards. They will have to submit a detailed capital policy plan, as well as explain how the bank will raise capital if necessary, and their intention in terms of dividends, share buybacks, and so on. So basically, the entire thing, it focuses on capital planning. How much capital you as a bank that you need to keep aside in case you face a stressful or a crisis situation. How can you maintain minimum capital? What is the policy on the capital? How will you raise additional capital if you face a loss? Alright, so all these things are part of the CCAR. And finally, since 2011, the Federal Reserve, they conduct stress test and requires banks to consider 3 scenarios. The first is a baseline. Okay, this is going to be the baseline. Then this is the adverse, and lastly we have severely adverse scenarios. So they want the stress test to be conducted on these 3 different scenarios. Okay, so that's it, guys. We are done with foundations of risk management revision, and as I said, do complete reading number 11, read it thoroughly, and good luck for your exam.